Hello, everyone. Today, we'll analyze the second largest cryptocurrency by market capitalization, Ethereum. And take note that I'm wearing an orange t-shirt with a bear on it, which means I'm feeling bearish and I'm not expecting any major growth from the market. A global decline is more likely. Now let's take a look at Ethereum's monthly candles. Here we can see a lot of orange circles and 3 yellow ones. The orange ones represent bearish engulfing patterns that were followed by further downward movement. In other words, after the engulfing, the minimum was updated, and sometimes by a lot. But the yellow circles are basically exceptions to the rule, where the bearish engulfing did not lead to further development. But note that 2 of the yellow circles appear after a major drop, which means they shouldn't really be considered exceptions, but rather as situations of sideways movement. For example, here, the green candle of December 2018 updated the local minimum and closed with a green body, which generally suggests a market reversal upward. But it was immediately engulfed by the red candle of the January 2019 drop, though without setting a new minimum. So this is no longer growth. It could be a sideways movement or possibly even a further downward move. But the February candle engulfs the January candle, and this again points to growth, especially after the January candle, having updated the local minimum, closed with a green body. And in the end, the growth did happen. The next yellow circle, first of all, appears after the market has dropped sharply, and secondly, the red candle closes above the level of $129.16, which is the base of the January 2020 candle. And one could assume that this was a stop-loss hunt, right? In other words, the market did not allow for a lower close. Again, one could have expected the movement to continue downward here, but as an entry point after such a massive drop from almost $1,500 to $80, well, probably considering a short here would not have been the most ideal decision. Then the market rises, an engulfing pattern with continuation. And here is the most complicated situation. An engulfing pattern occurred, but it was itself engulfed by a green candle, which in turn was again consumed by 3 falling candles, meaning the decline should have continued. But then we have another bullish engulfing, and finally it gets engulfed for the 3rd time. Yes, a growth candle appears and finds its continuation. So in fact, both this bearish engulfing and this 3-month one and this other 3-month one all played out, but through upward breakouts. In other words, no one was allowed to hold on to a short position unless they kept their stops somewhere in the red, behind some local or global high. And finally, the current situation. 3 months of decline are engulfing the growth candle of August 2025, which means the target for the drop is either the middle of the July 2025 candle, though we've already reached this level after the engulfing. So now the target for the decline is the base of the July 2025 candle, which is $2,485, and potentially much lower, down to the base of the May 2025 candle. And note that at the first level, we have the 50-month moving average, while toward the second level, we have the 100-month moving average. That's this red segment. Therefore, it's more likely that in the coming months, we'll see Ethereum priced around $2,500, and potentially as low as $1,800. Now, let's also take a look at the weekly and daily candles. On the weekly Ethereum candles, I didn't do any complicated markup. I just marked a single level, $3,095.29. This is the base of the weekly bearish candle from November 17th, 2025. Why is this important? Because this candle was ultimately engulfed by last week's rally from January 12th. But now, the current week is re-engulfing that bullish candle and turning the market downward for 2 reasons. First, it's a bearish engulfing pattern. Of course, everything could change in the remaining 2 weekend days, but most likely will close like this. And secondly, if we remove this level, it becomes clear that the candle is breaking down through the 50 and 100-week moving averages, which are green and red, respectively. This means that the target for this decline is, first of all, the base of this red candle from November 17th. That's $2,800. The second technical target is the 200-week moving average, which is still around the same $2,500. On the daily candles, I also didn't complicate things and marked only 2 levels that define the boundaries of the sideways range in the middle of 2025. Note that we tested the upper area of this range during the drop in November 2025, which means that if the decline continues, we could reach the lower boundary, and that's still the same $2,500. Now let's look at the current situation. At the moment, you could say we're in a sideways market, but there are a few particular features within this range. First, we're trading below all the moving averages. Second, the last engulfing pattern we had was bearish. That is, this growth candle on January 13th was engulfed by the falling candle on January 20th, which means we have reason to expect a further move down. And again, where to? To the area of $2,500. And finally, according to the RSI, the situation is also pointing somewhere here, to the region of 30. To sum up this review, I want to say that at the moment, there is absolutely no reason to buy. We have nothing but bearish engulfing patterns. We are consolidating below the moving averages, and we have quite specific downside targets in the form of the $2,500 and $1,800 levels, if we look at the monthly candlestick chart of Ethereum. Subscribe to the channel. My next review will be on Microsoft stocks. See you next time.